Between your entry and your exit is actually a zone of a market you're willing to risk. Now let's take for an example. There are three ways where we watch out in the market to exit a trade. Number one, it's the entry. Number two, it's your stop loss, your take profit, and your trend line break. I talked about a video about 10 trend line break earlier in our last video. Now today I'm going to be pointing you out to three ways where we use in exiting the market. Don't forget, your actually win rate in the market is determined by your risk. The level of risk you're willing to take in the market is what determines your winning rate. Let's take for an example. If you're always risking 5% of your account, you only need few trades that goes against you and you were able to blow up your account. Don't forget, the minimum reward we are expected from the market is three. For me, I'm cool with three. 1:3. I'm against 1:1 or 1:2. I don't even agree with that totally. I always agree with 1:3. Let's take for an example. I open a $50 position and I'm able to get three times of that. That's $150. I'm cool with it. Or let's say I open $100 and I'm able to get $300. I'm cool with it. But opening $100 and getting another $100, that is just $200. I just risk 100 to get back 100. I'm not cool with that kind of a trade. So it all boils down to what your level of what risk. I always advise folks to risk 1% of your account. Now, if you're risking 1% in the trade, you need 99 trades to fail for you to be able to blow up your account. And don't forget, the game is a game of probability. I've seen a case whereby I opened a trade and the market reversed and stopped me out, and I was able to blow up an account. Doing that consistently over time because of impatience while I started up as a beginner. But there is something I got to understand: patience and discipline to follow what I said I was going to be doing. So sticking to that helped me a lot. That when the market came to stop me out, I looked for another opportunity and actually played out like what anticipated. So in this video, I'm going to be walking you down to three ways. Now let's look at USD Swiss francs. Let's talk about the stop loss method. As you can see the clear picture, the market is actually bearish and the market has been respecting these trend lines here. So the market has actually come to back to this trend line. Now I actually have a confidence in this that the market might reverse back down. So what I want to do is a weekly. Let's go to the daily. There's something I saw this week. Something I saw this week. Okay, this market actually come to the trend line, but I pulled back to see what happened here. I got to understand that this market came back to the zone, came back here. Now if you go down to the 4 hours, there is something happening here in the 4 hours. Okay, now a lot of folks are going to be jumping here to enter a trade because they saw a candle here, so they're going to be rushing in to get a bulb in the chart. There is no doubt that the market wants to pull back, it wants to reverse. There is no doubt. Now let's look for folks that entered here. Let me show you something here. If you're going on a short position, entry here and moving your target here. Let me adjust this down. Now if you look vividly well, you will see something happening here. Okay, let's just say I entered the market here. Now there's every possibility that the market can actually come and stop me out. Don't forget, this is a good risk to reward. There's no doubt in it, but there is something missing out between this your entry here down to your exit point here. There's actually a belief that what you're trying to tell the market is, should in case anything go wrong, you're willing to risk this money, that the market should stop you out. That's the meaning of SL. SL means a level of an amount of risk you're willing to take to say that you're not 100% correct, because it's a game of probability. The market can reverse against you and stop you out. That's what an Excel means in a trade. That's one way of exiting the market, telling the market that you are okay with this level of risk. If the market should reverse against you and stop you out, you're fine with it, because why, you already calculated it. And there is something some folks mix two things. One, some persons fail to put Excel in their trade, which is very wrong. I can never open a trade without putting a stop loss. Now that is trying to tell the market that you are correct. And of course, you are going to be losing out. I've tried it a number of times, doesn't work for me. So I'm always cool with calculating my risk. Now, before placing my trade, you don't place an L cell immediately you have opened a trade. You actually calculate your trade before entering that trade and putting your Excel at the exact point you've already predicted that the market will not come to that level. Don't forget, this market came to this trend line here. You're expecting it to reverse, but the reverse has not happened. Some folks have already jumped in into the market. Now I prefer to actually wait and see what happens before what entering. Now the next one is this. Between your entry here, between your entry down to your target, which is a take profit, is actually another exit. Now what I mean by this is this: you are telling the market that if the market should come down in your favor and come down to hit your target, that the market should close your trade. This is what you wish to exit the market, also taking your what profit from the market. Here's another way of telling the market that you are cool with it. The market has given you enough money for you to what, to do whatever you want to do with. So you're going to be leaving that trade as a that zone. Now the next one is this. Some folks fail to understand this part, that a trend line can actually serve as an exit. Now, this market is not going to be rushing down straight. It's going to be giving us a trend line in the future. We know, of course, we know that the market does not move directly. It moves in a zigzag manner, where it gives us a retracement move, a pull down, a retracement move. So once that happens, you're going to be what, using that trend line as an exit. Whenever the market trend line is broken, you want to look for what is happening in the higher time frame for you to know if it's a retracement move and when to what, exit the trade. Now, in case you've not watched the video where I talked about how to exit the trade in the trend line, I'm going to be leaving the link in the description below. And also, if you have not subscribed to this channel, kindly do so and leave a comment when you guys know what, clear it, so we can what, give attention to it. Now moving on, the next one we look at is this. Never place a trade without an Excel, because it's not going to what, is very dangerous, because market, a news impact can just come in and what, stop you out. A news impact can just come in and what, make you blow up in your account. Don't forget, there's something I got to discover about the market. Whenever you place a trade without a stop loss, your entire capital is at risk. How do I mean? Let's say you open a mini lot. Let's say you funded your account with $1,000, and you're opening a trade of over 5%, for an example, or let's even say 2% in a single trade, 2% in a single trade with add and SL. Now, once that market move and reverses against you due to news impact, there is something that is bound to happen, and that thing that is bound to happen is that you will get stopped out. You might end up blowing up 50% of your account, maybe before realizing it, or you somebody say, I'm going to be monitoring my trade. Whoa, there's some news that flies, and the market all of a sudden what, moves against you, and that results to what, losing up to 10% of your account in a single trade, which is not actually cool. You would have been able to what, risk more. Now there is something I do in this market. Don't ever exit a trade without the market hitting your target, or hitting your XL, or breaking your trend line for you to see a reversal, break of structure and trend line break. What I do is, whenever I see a market and I discover that the market is about to reverse, I take partials. I don't close out the trade completely. Now I'll tell you why. Before placing the trade, don't forget, you do your analysis very well. You become patient. You wait for the market to come to you. You do all of this in the hourly time frame, the time frame alignment and all of that. It's not time for you to just close out the trade, because market hardly reverses like that. What you have to do is take out part of your profit. What I mean like by take out partials is, if you're opening let's say a standard lot, it is better you decrease your standard loss to a mini lot. let's say $100 account, $100 in size position, you can reduce it down to 50%, a $50, or you can take it down to 40% or 30% of that risk that you took and reduce it. And then the next thing you do is protect your trade. You move your stop loss down by protecting it back to where you entered and still allow the market to run. This way now, you are not being emotional. Taking partials will enable you to relax your mind. It will give you confidence. Now, another thing about you not exiting your trade, why I say you should take out partials, is because whenever you wait for a trade to come in your favor and you place a trade and the market runs in your favor, when you take out partials, having the confidence to say that, thank God for this trade, you're going to be saying, okay, I'm not going to be exiting it immediately. Even if the market reverses to stop me out, don't forget I protected my trade. And it will give you confidence to say, let me see what will happen next. That way you're not being affected. That way you're not being affected by the market. So whatever thing that happens, it actually happens in your in your favor. Either ways, you're still winning. Either way, you're still winning. But you going out to exit to close out your trade completely, that is not wrong. That is entirely wrong. Rather, it is wrong for you to close out your trade just like that. No, I advise you take out partials, or you allow the stop loss to be hit, or you allow your take profit to be hit. This way you calculated your risk up front. Now, one of the reasons why traders close out trade immediately once they see a reversal is because that risk, if you check very well, they were not willing to take that risk before the market moved against them. Opening a trade without predicting the reversal of that risk that you took is actually wrong. What you have to do is put that risk up front, calculate it before entering a trade. While you're waiting for your candle entry trigger to be formed, what you should be doing is calculating your risk. Check where you want to enter, check where you want to exit, check your target also, and also equally draw your trend line. So that way you have a bigger picture of what the market is doing. So this has a way, one of the benefits of this is it has a way of giving you confidence over time, and also patience, because when you're winning in the market, you are being prompted to try more, but once you're losing, you wouldn't want to try again. Another advantage is that sometimes when you think that market won't reverse, it might not really reverse. It might actually move in your favor. I've seen cases like that. It happened to me, was it last 2 months, I opened the trade and I got to understand something. Like we say, we always learn in the market. I got to understand something, that the market that broke in the trend line in the 4 and 30 minutes was actually a retracement move on the 4 hours. So what I did was I actually closed out partials in my I closed out the trade completely, rather, in my 30 minutes. So when I came back to see it the next day, I got to find out that the market has actually moved in my favor. I was like, whoa, that's just crazy. Okay, so when I got back, I got to understand that there was a retracement move in the 4 hours. So retracement move happen in these different time zones. So once you take out partials, it makes you to become what? More consistent and profitable on the long run. So that's all for this video. Don't forget to comment, like, and leave a comment section below. Thanks.